welcome to another episode of Blockrevision. And as yesterday's episode had been postponed to today, I decided to publish two episodes consecutively right this afternoon. So just be prepared for some fresh dose of economic knowledge being broadcasted to our YouTube channel. So today I'd like to put an emphasis on strictly market mover section, as that's probably the most important part for every single economic analyst or a trader in order to get to know what to prepare for on the upcoming week. And right over we jump to economy view and, as always, market outlook and cryptocurrency outlook as well, and we'll end up with some few words about trading prospects for the upcoming days. However, that, as I've mentioned, be shared to, or rather divided to two different episodes. So let's get into it. Right, so on market mover section we'll find it on Monday. We already had some data being published, but it wasn't really a hectic environment on 11th of July. So from Australia we had Westpac consumer confidence, and that one turned out to be more pessimistic than it been during recent time. Right now we can find that consumer confidence is dropping to the levels been recently seen right after this pandemic outbreak happened. So this inflation is really getting into nerves of consumers on that continent. So from Great Britain we have had a Bank of England government Bailey speech, and right over retail sales monitor year over year then turned out to be also negative. So UK is suffering from the economic environment, and right now due to not only me but many analysts is heading relentlessly into a recession period. On Tuesday we had already ZTW economic sentiment index, and this one surprised many economists, as that low level haven't been seen even during the pandemic dip. Right now we are striving with getting out of this minus 50 Sharia, but it looks like when observing the base of a tumble, we can find that still the worst might be yet ahead. So during this 2011 euro area crisis, we've seen also minus 50 levels, but this one is something that should bother us even more, as right after this very spectacular momentum of a move, we might had even drop down to these levels been seen during a global financial crisis. So that's from Germany, but it's not that. Trade idea will be a little bit further. On Tuesday we are already yet to be published data from China, that is balance of trade that's expected to be yet as the previous gauge, and we'll have exports and imports at 11 p.m. New York's time. On Wednesday we have very important data in terms of inflation rate around the world. So we have first from Germany right over from France, and from US also at 8:30. Right, as of next, we'll have from Canada interest rate decision that is expected to get even up to 2.25%, as also inflation is getting into economy of Canada. So unemployment rate from Australia will be also the gauge yet to watch over from there. Unemployment rate from Australia by far been quite low, but it doesn't seem it will maintain as like that. On Thursday we have another gauge of initial jobless claims that's weekly published, and we are expecting this level to remain at about 230-ish levels. Right over we have core PPI from US as the gauge of a little bit less merit than as CPI, but still worth watching. Next we have GDP growth rate from China, and that's very interesting to check, as we'll have a insight into what's going on in China right now, whether they have kept up to maintain this very good pace of growth during Q2. I don't think so, but it will be very interesting in order to verify what's the global sentiment will it entail. Right, so Friday, what we have on Friday, that's balance of trade from Euro area and retail sales from US. That's expected to get a little bit better than recently, but we have seen that recently this tendency is very, very pessimistic. So we are counting on maybe better gauge this time, but for that we need to wait by Friday. Okay, so it looks like it's everything. Right on Monday we'll have some other data, but I will let you know about it next week on next Monday. So we are jumping to another topic, that is economy view, and we are starting off with not very positive view on what's going on with economy. Recently Fed told that what we don't know is whether we're going back to something that looks more like 1994 or a little bit like what we had before. We suspect it will be kind of a blend. We are learning to deal with it. So Fed is confessing they don't really know what they're doing. They don't really know where we are heading to. So if they are losing their credibility, how could we really be quiet and really calm of what's going on with the economy? So it's better to protect ourselves by just gaining an economic knowledge and learn how to invest, maybe how to trade. So I find that you are right on the right channel, so I'm glad to have you here. And this one is exactly true with this point that there are different indicators that are impacting the outcome of what will happen, and even these passive investors types, we can find that that was the type of a behavior that wouldn't really shelter us from troubles in economy. Right now, this portfolio of 60-40 has surprised us to the downside, and even bond traders are reading, as we find, the Federal Reserve might be wrong again. So 2-year Treasury yields post biggest 3-day rise since 1980s, and there are some assumptions that there might not be yet over. So that's the time that we should really take care of what we are doing and take care of our finances. And with that, the nearly entire world is hiking interest rates and even tightening. China is still gaining. Manufacturing PMI recently shown better than forecasted, and we may find that after this COVID-0 policy being taken down, we may find that some positivity will get back to China. Right now we can find that with easing lockdowns and also some of a losing fiscal policy time, we might have maybe even more robust growth that might be justified with good economic data yet been published this week. That's worth watching. And it yet looks like just PMIs from China is getting better, but the whole other parts of the world right now are suffering from lower PMIs. That was recently at the second half of June, yet been catastrophically diminished data from PMIs from Europe, and we are still waiting for better times ahead. But with such projections as World Business Cycles is pointing right here, we still might be yet on the downside as it been during this financial global crisis. So we still have some room to drop. With these PMIs also been very low during 2020. We are in a very steep slope, and it looks like nothing that may resemble a pivot right around 35 around. So let's get next. However, for stocks, we recently suffered from the most volatile 5-week periods since 1928. So it was nearly so much bearishness accumulated in a very short period of time that may give us some odds that there might be a rebound, but at first we still need this justification in price action that we rather haven't seen yet. We need some big buy volume that might be for us a indication for big money joining back the market. And we recently have seen that also venture funding this year has been lower than any time during recent 1.5 year, and that means that we are in a quite a bearish sentiment level in terms of this type of investors actions, but it's quite understanding. As of next, we can find that the drop of WTI in the past has been a kind of a, and that's also very interesting, indicator with open interest of WTI and Brent crude in aggregate. So we can find that even with prices of WTI being stable right around hundreds levels, in terms of open interest, investors are losing their hopes on a higher WTI and Brent crude oil prices. So it means that after a very strong rally with I would say combination of not only higher prices of crude but also higher prices of nearly every goods, and after this pivotal been seen on the market, we may find that there should be some relief into the economy. Possible recession is still intact. That's why we still should be aware that WTI might lose its value, and that's not only commodity that has been observed losing value of recently. Also very important commodity has been observed slumping, that was copper. Copper by many is assumed as a commodity with intelligence, because it's a kind of a leading indicator of what may happen in economy. Right now the market is expecting to have seen observe the slump, and we can find that also the economic indicators are also not in a very good shape. So it means that still many might be ahead of us that still may bring more suffering. In terms of payrolls and jobless claims, we can find that this market is still keeping up with some good projections. However, recently we've seen a major differential between an establishment survey and household survey, with where the market may go, and with more and more civilians being afraid of losing their jobs. That's not maybe a leading indicator, but it may reflect the sentiment around the economy, and that may point that the anxiety between or among more and more people are diminished. Right. So what America's next recession will look like? Hopefully that they may be not as painful as a global financial crisis, but we still have yet many to go through, especially with possibly with bigger unemployment rate and more defaults on the way. So normally we find that right after market is and the US major index losing above 20% since the top, we've seen observe the recession during next couple of months. So this time is probably not being different, unless any major stimulus will flog the market once again. But as we know, with current inflation, that's really outstanding. So let's get finally to market outlook, and on markets we may find that Fear and Greed index right now has exceeded 25 points. So what does it mean? Right now we have got out from this extreme fear territory, and it means that might be room for rebounds, but as we observe, we still need to be very cautious. On the major US indexes, we have found, maybe I will just turn it on just to give you a better insight. I will show you that, for instance, US 100 is right now forming this sandwich pattern that usually may point a sign of reversal, but we still are suffering within this 12.150 points area. So it means that if we get across this top being drawn on consecutively 27th of June and 8th of July, we may find another peak right around this area, and for this one there should be find a much better sentiment been turning on. However, for now we are still holding this 200 weekly EMA, but there is still a chance to get the prices even lower, with this earnings week being on the run, and with first earnings being published on Thursday. So we still have an opportunity to get down to this lower 11,000 area, especially with this anxiety revolving around the market. Especially a little bit negative news is that buybacks by corporation clients have peaked recently after recent highs. So it means that there might be a lower interest, at least by the end of June, that this publication been attached to some reports. That's a lower interest than they're supposed to be on such a low territory in terms of US stocks. For us investors, that's something that is quite worrisome, but hopefully when the proper levels of buy zones will be achieved, more and more buybacks will happen. So it's a sign that might not be yet over in terms of this this seasonal slump. In terms of piling the cash, we are right now in investors' hands on the highest territory been seen since 2013. We still find that the cash piling action might get the levels even 10% higher than right now. So it means that we still might not be over with this rally downwards, but it means we are right now getting above recent highs, I would say, from this pandemic outbreak, and it means that we are right now heading into a bearish territory where more and more investors are deciding to stand aside the market, stand on the sideline, and just hang on for the better environment. Whether it's bearish or bullish, I would say it's kind of getting more bullish right now, but it's still in a bearish zone for now. So as of next, we may find it's a comparison of latest recessions. This one is median recession, median no recession time, and that's median recession on black bear market back to 1929. So if we just go through a just a correction without a recession, that would mean for us that we are right over it yet, and we may find possibly another bounce from a similar to today's areas on SPX. However, if it's kind of a recession, we may find a possible rebound from this area with this exclusion that we still are on the way down to another even lower low. So the bull trap may be still ahead of us, and as we find, this bull trap may occur even within months, even within a few months from here, and in the worst case there might be a recession extended to even 1 year left from where we are right now. And that's something that many economists, many investors are afraid of. We can find that global earnings estimates are at odds with share prices. So it means that even with this economic slump, even with this kind of economic troubles we are going through, the earnings estimates hasn't been revised yet, and there is a very strong probability that it will get slumped even with this little bounce been gone through recently. So with those PMIs and also with this high inflation that we are right now going through, there is obviously a risk of this global earnings being diminished in the weeks ahead with this earnings period getting over.